Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, last week we heard the Toronto home buyers had returned to the market, recording a 20% increase in sales during July. And then we heard that Vancouver had a record 30% drop. Last year at this time, the numbers were reversed. How does your firm interpret the latest market trends?
Okay, so both of those numbers, Jim, we would have interpreted them the same way that we've interpreted them for over 30 years. Now, what I mean to say by that is that we do not look at a single month of real estate stats and try to extrapolate where the market is heading or changes to the market. Organized real estate, the real estate boards and their trade associations, they are required by law, as we've said in your show before, to interpret stats this way. They have to support the sellers of real estate. Their MLS systems are designed and have a contractual obligation to get those sellers the highest price possible. There is no such contractual obligation with buyers. So when we see these numbers in Toronto being released, and we hear the real estate boards talking about June sales were up, July sales were up, we know, because of our use, the way that we interpret the data, that back in Ontario's great house price correction of the 1990s, the exact same phenomenon happened. So what your listeners can understand is that all housing markets function on the exact same way. They follow the exact same path. Doesn't matter about foreign buyers, doesn't matter about taxes, doesn't matter about interest rates. The market still follows the path. There's a whole bunch of levers that get pulled, and that will change the path. But when those levers are pulled, Jim, it takes a long, long time for those changes to be recorded. Usually over 2 years, sometimes as long as 4. So what I mean to say by that is that back in March of 1991, in Ontario, housing prices had been correcting for 14 months back then. 14 months of falling year-over-year house prices. But then magically, in March of 1991 in Ontario, organized real estate announced a magical thing happened. The average selling price in the month of March increased 3.4%. Then in April, a month later, they announced another magical thing had happened. The housing market, year over year, prices had gone up 4%. This was following 14 months of consecutively falling year-over-year monthly comparisons of house prices. They also went on to tell everybody that March, sales had increased over 43%. And then in April, they told everybody on a year-over-year comparison, sales had gone up 73%. Now, we were 14 months into the Ontario house price correction at that time, Jim. And a lot of innocent people listened to these comments, and they followed what the instructions organized real estate was subliminally telling them to do, which was buy now. The market is getting hot. Well, what I want your listeners to understand is this. In Ontario, it took another 9 years for that March and April prices from 1991 to get recorded again. On an inflation-adjusted basis, it took far longer, almost another decade, for those numbers to get reached again. So you just had the exact same thing happen in Ontario. You had declining home prices for a year, and now they claim housing prices are rising again. This has happened before, folks. It happened in Ontario back in the early 1990s correction. It happened in Calgary in 2016. It happened in Vancouver in 2017. And here we are in Ontario in 2018. It's happening again. These patterns are followed over and over and over again. The pattern has to be followed. These sales and these prices have to be recorded. What's going to come in the next 2 years has to happen. Sales don't dry up overnight, folks. Decisions people made last summer when they were out buying their homes, certainly a first-time buyer, takes months and months and months before the final sale of the most expensive home that was predicated on that very first sale from last year happening. Don't believe the numbers, because history shows the exact same pattern repeats itself.
Well, if we have the same pattern, what is that pattern telling us what's going to happen in the next 2 years?
Well, you've already seen the consequences, Jim, in Vancouver. You're already watching falling sales magically being announced by the real estate boards in Vancouver and in British Columbia. What they don't mention is that $37,000 interest-free mortgage boost, which caused rising condominium prices in Vancouver at the time when the market was rolling over to create the illusion things were busier than what they were. What your listeners don't understand, Jim, is that things are so slow in British Columbia right now. Everything that you thought you had been reading for the last year and a half has been eradicated. The market is way back at levels of 2015, all the way back that far. You don't hear that anywhere because people don't know how to read the market from the home buyer's viewpoint. We measure markets from the home buyer's viewpoint because home buyers are the only thing that matters. They are the only thing that matters in a housing market. The homes themselves don't matter. If there are no buyers to buy the homes, you have a stagnant market. Prices don't rise and they don't fall. That's what the truth is.
We'll have more with Ross Kay right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener was asking about buyer representation agreements. I guess they're being called BRAs. She was wondering what commission rate should be expecting to agree to pay on one of those. And what is it, by the way?
Yes, so I can see you're hesitant to say the word that BRA spells, which is BRAs. But that's exactly what they're called in some real estate boards. Certainly the biggest real estate board in Canada, the Toronto Real Estate Board, they call them BRAs. It's hilarious because women dominate the real estate market in the sales side, and to be using this acronym made no sense. So originally, Jim, they were called BAAs, Buyer Agency Agreement. A buyer representation agreement or buyer agency agreement is a contract that parallels the listing agreement, except it's done with buyers. So in the past, everyone would sign a listing agreement that would allow a real estate agent to market the listing. If the listing sells, the real estate agent would get paid. Now, in today's world, they have buyer agency agreements, BRAs, buyer representation agreements, which are the exact same thing. You list a buyer to sell them a house. What that means is if the buyer goes out and purchases a home and they don't purchase it from the sales rep that they've signed the buyer agency agreement with, that sales rep still has a claim and commission. Now, I'm not going to get into on the show here how you can get out of these deals because of the incompetence of the real estate profession and why there is no one in Canada who should ever have to pay for a buyer's agency agreement, because they're never explained properly to the public to meet the legal standards that are required to enforce the contract. But that said, in terms of what someone should be paying, agreeing to pay on a buyer agency agreement, I want your listeners to hear something here and think about it. In the month of July, or actually the month of June, in the month of June, your July data still can't be interpreted yet, by the way, listeners. So when you're reading these real estate stats, it is impossible to release information about the July housing market 48 or 36 or 72 hours after the month has ended. It is impossible. So I'm going to quote to you June numbers here, Jim. In June, the home buyers who were purchasing homes, so the home buyers who paid commission in the month of June were each paying for the real estate services for 7 other people. So they received real estate services, which they paid for, but they also paid for the real estate services of 7 other people who didn't have to pay. Those 7 other people got the exact same real estate services, but they didn't have to pay for it. So when you are signing one of these buyer agency agreements, you have to understand the failure in the real estate industry is so high that they have to ask those people who are successfully buying homes to not only pay for the real estate services they get, but they have to ask them to pay for the real estate services of between 5 and 7 other Canadians. So, does that mean that you should be agreeing to only pay 20% of the real estate commission they're asking you to pay? I would argue, Jim, in all fairness, I would probably never pay more than 40% of what the going rate is. The going rate now, your listeners can listen to this and understand. The average total commission rate charged on a sale of a home in Canada in 2018 has been 3.67%. Now, that includes goods and services tax or harmonized sales tax, depending on the province that you're in. But the total commission charged is 3.67%. Say we're to split that in half. We say that the seller should have to pay half and the buyer should have to pay half. And then we'll just take 6.37% and we'll divide it in 2. And then we'll also understand we're paying for the real estate services of other people. So we only want to pay 40% of that. Of course, you're not going to find a real estate brokerage, not the sales rep, you are not going to find a real estate brokerage in Canada who will agree to let you do that. The reason they can't afford to let you do that is they'll all go bankrupt. Your listeners should understand this. In June, in the month of June, forget it, we'll explain it to you this way. The Toronto Real Estate Board members, all of the real estate boards that are listing properties in the Greater Toronto area in the 12 months before the end of June 2018. So on an annual basis, the month ending June of 2018. The average sales representative in that geographical GT area sold one home. The total commission on the property that they sold was $28,000. That $28,000 is the average earnings of a real estate agent. From that, they'd have to take off thousands of dollars in fees, insurance, their car, everything else. The average real estate agent does not even earn a part-time minimum wage selling in the business. So in terms of what you should pay on your buyer broker contract or your buyer representation agreement, I believe it should be 1/2 of 3.67%, and it should only be 40% of that 1/2. There are real estate professionals in Canada today who deliver a degree of service that your listeners have never even watched advertised on television or in the newspaper or talked about by the real estate boards. And if you can get a hold of one of those professionals, I have no problem paying them half of the 3.67% average. Other than that, there's no way I would exceed 40% of that 1/2 of the 3.67%.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener posted a few comments about our last chat, and he questioned some of your analysis. He went on to claim a 1% rise in interest rates will result in a 10% drop in house prices. What would you say to that?
What I would say to that is that has been something that's been talked about by organized real estate and by mortgage brokers associations and Canadian banks who are seeing their profits decline as consumers save thousands, tens of thousands, hundreds of thousands of dollars over their lifetime because of declining home prices. That's what I would say to your listener. The 1% rise in interest rate, first of all, varies from city to city. A 1% rise in interest rates in Vancouver is not the same as a 1% rise, does not impact the market, the same way as a 1% rise in Calgary, or a 1% rise in Toronto, or a 1% rise in Ottawa. It changes in each municipality that you go to. Now, the reason it changes is because of the way property taxes are applied to a mortgage qualification. That's the reason it changes. But it changes, and it changes drastically. Then you have to take into consideration the sales mix. In other words, a 1% rise in interest rate for someone who is buying a first-time home with 5% down, they're drastically impacted by that 1% rise, where the mature homeowner who's lived in their home for 20 years and is moving up to a more expensive home, who is not even going to be carrying, who's going to have a 60% or a 40% loan-to-value ratio, so they're only going to have a 40% of their house value in mortgage. It's not going to impact them the same way. So because it's the 10%, that would have to be an average. And that is not what's happening. Your viewer is looking at it from the perspective of someone who's basically buying a house with no money down. This is the same mistake that academics make when they're talking about affordability. It's why the Royal Bank Affordability Index doesn't work. It's why Andy Yan mistakenly, when he compared San Francisco to Vancouver, you can't compare the two. It's how they're mistakenly talking about people having to work 30 years or 20 or 30 years to save for a down payment. It isn't how it works. I understand when you're standing back and you're looking at it, trying to find an answer that this may make sense. But when you're sitting down with a spreadsheet in front of you and you're seeing how buyers are interacting with the market, and you're seeing how a first-time buyer, a second-time buyer, a third-time buyer, a fourth-time buyer, a fifth-time buyer is all arranging their mortgage financing totally differently from one another. And then if you went to another city, even out to Abbotsford for the sake of the argument, from Vancouver, and you looked at how those buyers were arranging their financing, you would understand that you wouldn't say that. 1% equals 10% house price drop. You also would understand that as interest rates rise, each successive increase in interest rate has its impact in the market is not as great. And this is how you know, like back in 1990, a 3% rise in interest rates is basically the same as a 0.5% rise today. You have to understand how all these numbers interact. You can't know that unless you have all of the housing activity that's going on today. You understand how each category of buyers is buying, what percentage of the sales they make, and how that in aggregate will impact the market. So that's why a 1% rise in interest rates creates a 10% house price gain is just not something that you would ever want to use to make a home ownership decision.
Ross, we're hearing about real estate investors who have bought new condos and are now losing money on them each month. I know you work with investors. How do you handle these kind of situations?
Well, this is another one of the myths about real estate that people who sell real estate and people who sell courses capitalize on. So the very first thing that we would tell investors is the same thing that we've told them for, 40 years, is that what the monthly payment, cash flow should never be the goal of real estate for the first 15 to 20 years that you own the property. Your first 15 to 20 years that you own a property as an investment should be to build equity. You should not be thinking about taking any cash out of the property at all. If there is a shortfall in terms of what your rental income is to what your expenses are to own the property, then that is a loss. If there is a positive cash flow, if there's positive cash after all your expenses have been made, then the property is generating an income. In both of those cases, you should not be taking money out. One of the great things about investing in real estate at the low interest rates that we have had for the last 5 years is that you really didn't even, if you were looking on cash flow, if you were paying for a course that told you how to get cash flow, if you were being sold the bill of goods that cash flow is what matters, you were missing out on the opportunity that was there. Cash flow is being measured without taking the amount of principal that you are paying down each month. My firm, the clients that we have, Jim, the investors that we have, these are mature, sophisticated real estate investors. They understand that the equity that they are gaining is their cash flow. their equity that they are gaining is their investment, is the return on their investment. They also know that over time, their return on investment naturally declines because the amount of the investment is continually growing when the return stays exactly the same. So there is a chart that we do for the investors that show them what their equity curve will be, and they know over time where they should be acting in the market. In other words, I should be getting another property now at this time because I'm not getting the return on this single property any longer. This goes back to, Jim, really the discussion about this old burning my mortgage, paying my mortgage down as quickly as possible myth. The absolute worst advice you can give to anyone who has 50% loan-to-value ratio is to pay down their mortgage. The best advice you can give them is continue to make the exact same amount of payments that you would have been making on your amortization. The only difference is instead of investing the money into your house, which is called principal, take that money and give it to a financial advisor and let the financial advisor manage those funds for you. People who follow that strategy, Jim, over the long haul. Now, I understand they have to be sure that their home value is correct. They have to be sure that these funds are monitored in the right way. They have to be sure that all the bases are covered, which you can because you've got lawyers and accountants. Those people's return in their house, Jim, is triple what the average Canadian homeowner experiences over 25 years of ownership. That type of return, Jim, as we're into the rising stage of the interest rate cycle, is only going to get greater. In other words, the multiplication factor of the homeowner who doesn't continue to pay down their mortgage is going to be greater. We have to accept as Canadians, for the last 40 years, Canadians have bought, sold, and owned their homes in the exact same way. They have gone out, approached the process, acted in the process, followed up in the process, and lived their lives as a homeowner the exact same way. They've done it whether interest rates were 15% or interest rates were 3%. It is exactly the same. When you understand what home ownership behavior is, it's simply better just to embrace it and capitalize on it. If you want to ignore it or you want to think you're the outlier, the odds in success are 0.0001. Like, they're so astronomically low, it's not even worth discussing. So why not just embrace the way that all Canadians own their homes, learn from past generations, and just simply apply today's realities of mortgage interest rate and employment and inflation, and let those old behaviors become your friends in the future.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or the show, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.